Hi everyone, today I decided to share with you some manufacturing financial model overview. So manufacturing financial models are always very interesting because before you start calculating the dollar amounts of revenues, costs, first of all you need to build the breadth of equipment, to put all the equipment specific features, shifts, hours, and so on before you start calculating the revenues or direct costs. That's why all the manufacturing financial models sometimes a bit difficult to build, because you need to put inside in Excel all the manufacturing processes and then add dollar amounts to the physical processes that appear to be inside the manufacturing facility. So today I will be overviewing brick making facility. If you find these overviews valuable, please like, share and subscribe to our channel. So we have maybe several hundreds of models. I will be overviewing them, posting them one by one. It just takes time, but we have a lot to show you. So first of all, we need to create a rule saying that all our inputs will be colored with specific color. So we are saying that this blue color will be the inputs. Here they are. All other cells are automatic, they contain only formulas, so this will be convenient for you, for all the third parties who will be playing with your model, your investors, bankers, whoever. So this will ease for you to find all the inputs through the whole financial model during stress testing, scenario building process, and so on. So this will ease your life if you highlight your inputs. So first of all, we set up the first year of financial projections. Then we are setting up the productivity of our brick making facility, how many bricks per hour we are going to produce. So we are saying, so we have some standard brick, and we are setting up the productivity in standard bricks. So in this case, for example, we are producing 2000 standard bricks per hour. Then we are setting up the shift duration in hours. So you may have 8 hours shift or 12 hours shift. So then the hours will be calculated, will be multiplied on the productivity, and that's how you will get the realistic revenue. So you can't just say that I will be producing that amount of bricks. So you will have lots of variables like how many shifts, how many working days per month, that will be losses, different types of losses. So all of that you'll have to take into consideration. So now we need to specify some starting point when our brick making facility will start its operating activity, when we get the first revenue. So that will be, for example, February 2024. We can play with this moment, we can specify the month and year, play with it, because later when financial will be ready, you'll be playing with all this stuff a lot. So and all the investment plan, all the direct costs, salaries, payroll will be linked to this magical point that you will be specifying in this dialog menu. Then we are moving forward. So then we have the next very important block of inputs. So here we need to specify what type of bricks we're going to produce. So for example, here, so first of all we need to specify what type of bricks we are going to produce. Then we need to specify what type of brick that will be. So that will be, for example, half of standard brick, this will be a standard brick, 1.5 of standard brick, and this will be, for example, huge blocks. So all these bricks will be completely different. Then, for example, we need to be able to switch different types of bricks from calculations and see how the cash flow statement, P&L statement, simple discounted payback period will look like if we switch on and off different formats of bricks from calculations, and see if we are too optimistic with this or that type of brick. So this will give you a lot of information while you will be playing with scenarios, stress testing actions, and so on. So being able to switch on and off different products from calculation gives you a huge portion of new information about your business idea. Usually people, so entrepreneurs are playing with these switch on and off buttons a lot, so they sometimes change their business concept during this scenario play, so they learn a lot about this. So this block of inputs makes them let's say gives them a new portion of the information about their business idea. So how flexible it is, how stable it is. So this is very valuable column. Then we can also add the coefficient for the amount of bricks that we produce. Here we can increase or decrease specific type of brick that we would like to produce. So we can increase it directly here, or we can increase the whole volume that we're going to produce here. And what is valuable, for example, if I increase it more than we can produce, this will give me a mistake. Here it is. So this is how manufacturing models work. So you can't just say I would like to produce this amount or that amount. You have equipment capacity, so we're building different limitation systems, limits, and these limits are let's say give you some corridor of manufacturing values that you have to stick to. You can't sell more than you produce. So these conditional formatting indicators are showing you whether you are living in real numbers or in fake. So moving forward, now we need to calculate the hours, the working hours of our brick making plant. So here from left to right we have a typical year from January to December. Here it is. And then you need to specify how many working days per month you have in each month and how many shifts you will be working every month a day. So in January, let's say we will be working 1 shift. In summer, let's say we will be working 3 shifts a day. So we can specify all these details to get the more realistic revenues that you will really that you will trust, because the most important thing about financial model is trust. If you don't trust the revenues that you get inside your cash flow statement, then this model is useless. So this means we need to use as many parameters that affect the revenues as possible. So in this block of inputs we're specifying how many working days we have in each month of a typical year and how many shifts per day we will be working. Then we need to we're moving forward to the working time. So here we have typical year from January to December. Here it is. And now let's say we have 100% of working time, and we need to allocate this working time across all the types of bricks that we produce. So let's say in January we may produce 1 types of bricks, in June we may be focused on producing of another type of bricks. So this may be a very flexible model, so that's why it is very important for the entrepreneurs who are going to start this business to be able to play with all the sales plan parameters, what we're going to sell in during winter months, what we're going to sell in summer months, spring, and so on. So that may be different types of bricks. So here we're able to allocate the time across the different types of bricks that we're going to produce. Then we are moving to the let's say target values of the revenues. So here we have this is the first month of operating activity, and then we are going to the future. And here we need to, so we are assuming, so basic assumption is that we can't reach the target revenues, target manufacturing plan right from the first month of operating activity. So we will be reaching these target revenues month by month, step by step. And here we are setting up how fast we are going to reach these target amount of bricks that we're going to sell. And this is also a very important blocks of inputs, because this block of inputs affects the amount of financing that we're going to need. This affects the operating losses during the period before we reach the break-even point. So if we let's say if we reach only 5%, then 10, 15, 20% of targeted amount of manufacturing of bricks, then let's go further. I will show inside the cash flow statement. So this is the month when we get the first revenues, and here we can see the operating losses. Here they are. You can see these reds. So this means we need to finance all these operating losses. We can use equity for that, or loan. So this will affect the financing needed for your business idea. That's why playing with these percentages, you will be able to see how much financing you will need in optimistic scenario, pessimistic scenario. For example, you will reach 100% during 3 months period, 6 months period, or a year or half a year. So this is very important. This significantly affects the money that you will need to start. Usually when financial model is ready, entrepreneurs are playing with this block of inputs a lot, because they see the gap between optimistic and pessimistic scenarios. So this gives them a huge portion of new information about their project. Then we start covering direct expenses: clay, different ingredients that participate in brick making. So here from top to the bottom we have different ingredients, components that we use in brick production. Then we are specifying the price per 1 unit of each component that we are using. Then we have a coefficient for the price, for this price of a direct expense component. We can to be able to increase it and look at the simple discounted payback period, cash flow statement. So we are not touching the values of inputs itself. We're just playing with coefficient. That this shows us the flexibility, the stability of the model. So this is very convenient. And then we have from left to the right, here they are, we have all our types of bricks that we are producing, and then we are specifying how much of each ingredient in its matrix we need for manufacturing of 1 brick of each type. Alright, then we can also add a coefficient for all direct costs. So if we would like to see what will happen to the cash flow or to the simple discounted payback period if we increase the direct costs on 20%, we just type here 120, and we can quickly go to cash flow, look at the simple discounted payback period, and see what will how this increase affects all these statements. Then we also then we're moving to the next block of input. So this will be purchase parameters. So here from top to the bottom we have direct cost components, and this column is also very important because we may finance the direct expenses from the revenues, or if sometimes we need to buy the component beforehand and then we will be using it in manufacturing process. So this means that if we say no here, this means we can finance it from the revenues. If we purchase this component before, this means we need to spend money from our pocket or from the cash flow to finance the purchase of these direct expense components. So so here we can finance it from the revenues, and here we need to finance it from the equity, loan, or for example the cash that has already been accumulated by the project, and so on. And then we also, so this is why we need that. So we need that because if we say yes here, if we say yes, this means this may affect or may not affect the overall amount of financing that we need. So all these parameters affect the amount of money that we need. So this affects, and also another parameter that is also very important is the purchase cycle. So for example, some components we may purchase once in 3 months, once in a month, once in 6 months, once in a year, and here we need to specify how often we purchase this or that ingredient that participates in our manufacturing process. So this is also very important because this affects the amount of financing, this affects the working capital that we need for the project, and so on. So this affects significantly. Then we are moving to the sales plan. So the trick about the sales plan is that, so here we have the typical year, and what is interesting, so for example in winter we may be just manufacturing the bricks, and we are going to sell the majority of this volume during the summer months. So here we have, for example, in January we are saying that we will be selling only 20% of what we are producing. So here we will be selling 30%, 50% of what we are producing, and then for example in June we will be selling 150% of what we are. So we have some warehouse, we will be accumulating the bricks inside the warehouse, and in July we will be selling twice of what we've produced. So again, that will affect the overall amount of financing that we need, and this will show you the realistic seasonality of your business. So here we are playing with the percentages of what we sell comparing to what we produce. And also we may have some overall pricing coefficient that is here, and now we are moving to the pricing strategy. So we have going to from top to the bottom. So first of all, we have different types of bricks that we are manufacturing. Here they are. Then we are assuming that we have, let's say, 5 types of customers sitting inside each sitting inside each type of brick, and here we are allocating 100% of the volume of this of what we produce across these 5 types of customers. And then we have 3 months after this customer purchases our brick, and we can specify how this type of customer pays us. So for example, customer type number 1, So it takes 5% of volume of brick number 1, and he pays us just 100% at the month when it takes the bricks. Customer type number 2, he takes 15%. He takes more, but he pays us today 50% of what he purchased, and next month he will be paying us another 50%. So here is then, for example, the next customer number 3, he takes, for example, 50% of the volume, but he doesn't pay us today. He doesn't pay anything today. He will pay us next month 100%. So this also affects the operating losses, amount of working capital. So you can play with all these percentage values and see how that will affect the cash flow statement. And all these types of customers may have different prices. We can increase these prices. We can, for example, use the overall coefficient for each of these 5 types of customers, or you can play directly with each of them. And the same logic is here. So, for example, if I would like to allocate more than 100%, this will give me a mistake. Now let's move forward. Then we are moving to the pellets. So remember that we are producing different types of bricks, so standard bricks or big blocks. So they are all when a brick is done. So we need to carry it to the warehouse. So we are putting these bricks on the pallet. So if we are talking about standard bricks, so we may have, let's say, 200 bricks on one pallet. So first parameter that we need to set up is the price of a pallet. This is the first parameter. Then we need to specify how many bricks are living on one pallet. So if it is a standard brick, we may have 300 bricks on a pallet. If it is a big block, there will be only 50 blocks on a pallet. So this is also a very important block because it affects the amount of pallets that we need for our brick making facility. Then we're moving to electricity. So we are specifying the price in dollars per kilowatt here, and then we also specifying the consumption of electricity per hour of our manufacturing lines. Here it is. Then we are moving to the fixed costs, and despite of them being so called, so we may have some staged fixed cost expenses if we work depending on whether we work 1 shift a day, 2 shifts a day, or 3 shifts a day. So here we specified the fixed cost items, and here we specified the level of expenses for each item if we work 1 shift, 2 shifts, or 3 shifts. Then the same story with the payroll. So here we have the list of positions, then we have the salary per person on each position, and then we specify the headcount for 1 shift, 2 shifts, or 3 shifts per day. Then we are moving to investment plan. So here on the right, this is the moment when we start the operating activity, and then we're going back, and here we specify what we are investing in, and here we specify how much we are investing in. Then we have the loan, so we can specify when we get this loan, year, month, amount of loan, interest rate, loan term. If we have any grace period for principal or for interest, we can specify it here in months. Then we can specify the tax rates, And then we are moving to the cash flow. So the cash flow is showing us how much financing we need in this particular scenario. So we can see that we need this amount of equity. This is the loan that we have. And if we look at so we can use the plus buttons to see all the details of the revenues, direct costs, fixed costs, payroll, and so on. And then if we look at the last line of the cash flow statement, we will be able to see that here we are eating the cash, we are eating. Here we started the operating activity. We have still some losses, so we need some equity to compensate these losses. And here we can see the mathematical zero. And since May 2025, for example, we don't need extra financing. Our project started generating its own profit. So this is how you can read the cash flow statement yourself. And this is showing us how much of equity we need, loan we need, total amount of financing needed. So usually the entrepreneurs, when they build scenarios, they look at the cash flow statement, look when mathematical zero happens. Where is that? Here it is. So they are making lots of scenarios because they would like to see how flexible their business idea is, how stable it is. So here we can see the simple payback period diagram. We can see the investment stage, the operating stage, seasonality. Here we can see the financial efficiency, simple, discounted payback periods, net present value, profitability index, internal rate of return, total financing needed, and so on. Then we have a simple table with revenues, expenses, profit, profitability. These are the table with simple and discounted payback period shown together. Here we can specify the discount rate. And then we are going to sensitivity analysis, so we can add this parameter to any input and see how these parameter of revenues or costs affects the simple discounted payback period. So we can let's do the following. So we can for example, we can play with the pace. So this affects this. We can do the following. Now we can go up and add this parameter, for example, to the pricing. Let's go direct expenses. Let's add it to the direct expenses. We can press equals, multiply, then we're going to sensitivity analysis, add this coefficient, pressing enter. Let's go back and press sense button, and now we'll be able to see how increase or decrease of direct expenses will affect these all the financial efficiency numbers. So what we can do, we can, for example, increase the pace, and we can press again the sense button. So using this instrument, using this tool, you will be able to see how flexible your scenario, that your current scenario is. So now you can do the following. You can detach the coefficient from the direct expenses and add it, for example, to the pricing. You can add this coefficient to specific customers, so this is very flexible. So now I'm adding this coefficient to pricing. I'm going back and pressing send button. So that's how it works, guys. So this was the brick making plant financial model overview. If you find these overviews valuable, please give us a like, subscribe our channel. Soon we will be posting new manufacturing models, startups, different types of business ideas, overviews. I hope you will enjoy it. So see you next overviews, Power BI tutorials. Bye bye.